Hey guys, what's happening? Eric here, Mr. Fired Up Wealth, and I'm excited today to bring you the final video in the DGIF series. That's the Dividend Growth Investing for Fired series, covering the top 60 dividend growth stocks for the next decade. Now, if you're not familiar with this series, we're going to put up a playlist at the end. I encourage you to go back and look. There's a total of 7 videos. Today is the last video, and today we're covering the best 2 sectors, in my opinion, my favorite 2 sectors, which are technology and communication services. Now, if you know anything about me, I have a technology background. I work in the technology space. I work in the cloud space, actually. And so this one was fun to make, but also challenging. I needed to make sure I got it right. So we're picking out the top 10 dividend growth investing stocks, but it's not just any DGI. These stocks are focused on total growth. So not just growth of the dividend, but also we want growth in the actual company and the actual share price. So we want total growth as a long-term investment. So I'm going to give you my top 10 picks in the technology and communication services sectors. Afterwards, we're going to go ahead and break down those 10 picks. We're going to compare them and kind of compare the strengths and weaknesses of the 10. And then I'm going to give you a whole bunch of bonus picks. So I encourage you to watch this entire video. These are excellent picks, and I'm excited to get started. So without further ado, let's get going. All right, guys. So we're going to kick off the top 10 technology and communication services dividend growth stocks with number 1. Of course, it's got to be Apple. It just has to be. Obviously, they've got this huge 5G super cycle coming. It's a great company. It's paying a 1.24% dividend yield. It's just under a 20 PE ratio right now. Of course, this thing has been absolutely hammered, like most things in the stock market. We're in a bear market right now. We're down over 20% off of the highs. You can see that Apple went from $327 on January 29th, 2020 to $257 today. And so today is the 13th of March, Friday the 13th. But here's my phone. It's a iPhone 7 Plus, right? And I use this for work, and I have a well-paying job, and I travel all over the United States and even globally, and I'm still using this. So a lot of people like me are waiting for the 5G phone. Why go buy a new iPhone 11 when I can wait till the 5G one comes out? And so that's what I'm doing, and I know a lot of other people are. And trust me, I worked for Oracle back in 2008 and 2009, and that was really the first major iPhone super cycle. And, my clients at that point were AT&T, Verizon, Sprint. So I'm really familiar with the communication services industry. I sold into the communication services industry, and this is going to be much bigger than that first super cycle. And because not only are there more people to buy the phones, there's literally everybody has to replace their phone if they want 5G. Your iPhone 11 is not going to work with 5G. So doesn't mean you're necessarily going to have 5G service everywhere, but you're going to need to replace your phone in order for it to work. And so, this is before kind of the last couple of weeks have been pretty chaotic, but before this all happened, Wedbush analyst Dan Ives had an outperformance rating of $400 price target on the stock. Will it get $400 tomorrow? No. Could it go lower than $250? Yes. Is it a good price at $257? I think in my opinion, I think it's a great price, but that's your decision to make. What I'm here to do is tell you what I think about the stock and the reasons why I would pick this as my number 1 stock, my number 2 stock, and so on. But these guys, Apple, are heading for a super cycle that will spur demand for the 5G iPhones. And that's expected really to start later this year. Now, of course, there's some risk because you think, well, China's been impacted and, they're not going to be able to start this in 2020 anymore. Well, Tim Cook actually came out 2 days ago and said that China is basically up to speed. All of the iPhone or Apple stores in China, except for 2, are open as of 2 days ago. And the factories are at 80% capacity. So could it delay the super cycle by a few months? Yes. If you're a long-term investor, though, will it stop Apple from being worth, more than $250 in 5 years? I mean, it's silly when you actually talk about it that way, but there's always the fear of what if it goes lower? Well, dollar cost average in. Or if you think it's going to go to $150, then wait till 150, you know? But you know, there's 215 to 200 million, somewhere in that range of basically 215 million iPhones in September of 2021 fiscal year. So next year, 2021, they're predicting around 200 to 215 million iPhones will be sold. And that's going to exceed the record cycle from 2015. And, you know, of course, I talked about 2008 and 2009. That was the first one. 2015 had kind of another mega cycle. And this is going to be the same thing. I think this is going to be the mother of all super cycles. I really believe that. And no matter how you slice it, own an Apple over the next 10 years is just, in my opinion, a good investment to make. The upgrade just in China alone is 60 to 70 million iPhones that are going to be upgraded. And then the super cycle on the horizon, of course, is the main driver, but it's also the $50 billion in annual services business. And that's continuing to grow. So, I mean, they're well diversified, different segments. They've got the Apple Pay. They've got the Apple Arcade that just came out. There's Apple TV Plus. There's a lot of things to like about Apple here. So that's number one. Number two is one of my favorite stocks. I've had this stock forever. Not forever, but I've had this for, I don't even remember, 2012. So I've had it for 8 years. I bought it when it was way back in the, I think $30 or something. And I added a bunch in December of 2018 when it was down to $100. It's now gone from $190 to $145. It's yielding a 1.5% yield, 24 P ratio. There's so many reasons to like this stock. First and foremost, what everybody knows is the cloud, right? So Microsoft Azure, that is going to be a growing business. They predict about, be conservative, we'll say there's a 20% saturation in cloud right now. So there's still 80% run rate. And there's really only, there's a handful of players. The two big dogs, of course, are Amazon with AWS and then Microsoft Azure. There's also Google Cloud There's some smaller players like Oracle's trying to get more and more in that space. There's a few others out there, but really the two big dogs are going to be AWS and Microsoft. Google is pushing really hard to get in that space, which is why I own Google, but Google doesn't pay a dividend. So that's a different video, different story. But the cloud business, that's the main reason that you own Microsoft is probably because of cloud. But there's a lot of other reasons to like Microsoft, just like there's a lot of reasons to like Apple. And, with this one, both Apple and Microsoft are growing their dividends. They're paying a healthy dividend. They have the cash in order to pay that dividend. And you're going to get paid to wait because these companies are going to perform over the next decade, and something that I own a lot of, and I would continue to add more. If these rates stay down here, every paycheck I get, I'm throwing more into companies like this. Surface, Microsoft Surface. So you think of like NFL games, that more and more being used. It's only 3.8% of their revenue, but it's growing very fast. So that's something to keep on the radar. I think that's a good growth opportunity for them. And then Windows 10. A lot of people might not know this, but Windows 7 support just ended in January of 2020. And so that means a lot of people are going to have to upgrade licenses to Windows 10. And that's it's a recurring revenue stream. And, everything is subscription based, cloud based with Windows nowadays. So you used to get a CD, and you would actually get the CD, you would install the CD. Once you bought that CD, people would sometimes share them with other friends, whatever. This is all subscription based, a lot harder to do. And they're getting recurring revenue, on an annual or a monthly basis from either individuals for their homes or from businesses. And it's a huge moneymaker, and it gives a constant revenue stream. It's very hard as a business if you don't have the recurring revenue stream, because you're going to have peaks and valleys, ups and downs. Your sales cycles are ups and downs. When you have recurring revenue, the reason that investors like software companies with recurring revenue streams is because it gives you clarity. It gives you vision into what future sales are going to be. Unless people are canceling their subscriptions, it's a pretty safe bet that if anything, a company is probably going to grow licenses, not suspend them. And so it gives you a very very good visibility into the growth and the performance and the revenues of the company when you have that type of model. Another thing is Microsoft Teams. Like my company that I work for, we're required to use Microsoft Teams for all of our meetings. And of course, now with the coronavirus, more and more people are working from home. And I think that, every time you use Microsoft Teams, you need a license for that as well. Same kind of deal. And so now, say a company sends 120,000 workers, AT&T just announced today 245,000 employees have to all work from home. Well, if they're not used to working from home, maybe they work at an office where they have a desktop computer and they don't have a laptop. Well, now a lot of these people, either they're going to have to go get laptops and install the software, or if they have something at home, they've got a computer at home they're using, they're still going to probably need a license. They might not have had Microsoft Teams before, and now maybe they have to upgrade their Microsoft subscription to include Teams. So I think there's some opportunity, and I think just the trend overall, more and more people are going to be working from home. So you're going to see a growth in Microsoft Teams. And then artificial intelligence, you've probably seen commercials with, Common on TV. It's larger than the cloud. And I mentioned, with cloud earlier, there's about 80% run rate, and Microsoft's one of the major players. But long-term, artificial intelligence has even more potential. And so when you think of Microsoft as a long-term hold, they just have tremendous opportunities, both short, medium, and long-term. And it's one that a lot of people like, and that's why it's so popular. And it was $190 before the market crash. They generate significant free cash flow, about $38 billion last time I checked in the trailing 12 months. Just like Apple, they have lots of cash. They can afford to pay that dividend. It's safe. These are no-brainer picks in my opinion. And number 3, and if you're looking for a lot of yield, you can probably just skip to number 4, because this one doesn't pay a whole lot of dividend yield. It only pays a 0.3% dividend yield, but it is true DGI. It does grow its dividend. Of course, Nvidia, and I like Nvidia because it's a great growth stock that does have a dividend. It's going to continue to grow the dividend. You can see that it was once $316 just back in February 20th. Today is March 13th, and it's now trading at $225. It's still a little bit expensive, of course. The PE is 47. So if you're more of a value investor, this might not be a pick for you. But if you're a long-term investor, this is a company I know very well, and they have a history of outperformance. They dominate in the graphics processing market. Now AMD is doing more in that space, and they do a great job as well, but AMD doesn't pay a dividend, so it's not on the video, but it is something that I do like as well. Nvidia is improving margins. They have strong cash flow. So these are the kind of companies that you want to own when you're in a downturn market, when you're in a bear market, potentially a recession. With that said, Nvidia is not one that will perform well in a recession, because that 47 PE, it can go a lot lower than this. But it does have a rich, cash balance sheet. The capital returns are good. The founder and CEO, he's got a lot of skin in the game, not only financially, but also just with pride to want the company to do well. They have a tremendous data center opportunity. So, when you sell cloud, so I sell cloud services. When you think of lift and shift from PeopleSoft, so on-prem, and you're taking that data and you're lifting and shifting into like an OCI, which is Oracle Cloud Interface. You're using OCI, and maybe you're going to all SaaS, so you might be doing a software as a service. You might be doing infrastructure as a service. You're going to need data centers for all that, and it's we talked about the 80% run rate left on cloud. Nvidia is part of that cloud story, and they do a lot of great work with the chips that are required for data centers. AMD as well. Both of those are doing a good job. And then crypto, I wouldn't own Nvidia just for the crypto opportunity, but it is an opportunity for growth. I think Bitcoin was hit even harder than the S&P 500 over the last couple weeks. I think it was down almost 50% versus the S&P down about 25%. So that's one, with Bitcoin, it's not something, it's not a reason to buy Nvidia with cryptocurrency, but it is something that I think still is worth mentioning. And self-driving car technologies, I made a video, top 5 autonomous driving, stocks, and Nvidia's on that one. That's one of my best performing videos actually on YouTube. So if you haven't checked that out, take a look. But they do some really cool stuff with the graphics and sensors for cars, so that they can obviously be self-driving. And it has really one of the best workforces on the planet. If you know anybody that works in NVIDIA, they've got tremendous, engineers, PhDs, MIT grads. Not only they smart, but the tenure is amazing. The turnover is very, very low. The people that work there love the quality work environment. They want to work there long term. They have skin in the game. it's an amazing company that I personally am proud to own. I know that it's going to be, up and down and all over the place, but I'm comfortable owning something like Nvidia because I know in 5 or 10 years, I believe, in my opinion, it's going to be worth a lot more than it is today. So Nvidia is the third stock. Number 4, this could actually this this could be number 1. I like it that much, but of course, there's no way I can say Lam Research is better than Microsoft or Apple. For most investors, this is probably going to be more of a comfortable pick maybe than Nvidia because it is 1.93% dividend yield with a 17.62 PE ratio. They had a blowout quarter right before this whole debacle with coronavirus and the crash in the stock market, but you can see that the outlook is stable. Lam Research rating to A- from BBB plus. Outlook stable. This isn't a company that's in any danger through any economic downturn. Of course, you're going to maybe have a little bit, less microchip activity. People buying microchips. I don't think we're at that point, guys. I don't think this is going to be a 2-year recession or anything like that. I think it's short term. I think we have maybe a quarter, maybe 2 quarters of low growth or zero growth, and then it's off to the races. In 18 months, we're back to the same levels we were before, maybe even all-time highs. I could be wrong, and Lam Research could go down to $171, but I feel comfortable owning at $250. I got into this stock probably at $75. I've been in a long time, and it's been one of my top performing stocks. It was up last year. It was one of the top performing stocks in the S&P 500. It was up over 100%. So if you haven't heard of it, the stock tickers are LRCX. It's a great company. What they do is they make semiconductor equipment, so manufacturing equipment. We'll just read the profile here. Lam Research designs, manufactures, markets, refurbish, and services semiconductor processing equipment used in the fabrication of integrated circuits worldwide. And I won't read any more than that. But that's, this is the equipment that companies like Nvidia, AMD, on and on and on, Marvel, they buy machinery from Lam Research in order to make their wafers, to make their circuits. So there's a couple of companies like this. You've probably heard of Applied Materials. For whatever reason, Applied Materials is always the one that people talk about more. And there's probably 3 or 4 other ones, and they all have performed very, very well. Even after being down from 344, this thing's still up 38%, 52 week. So take a look at Lam Research. It's my 4th pick. It's one of my favorites. It's one of my top holdings, actually. And, as long as everything you own has microchips, Lam Research is going to be a great company to have in your portfolio. Number 4 is Skyworks. And if you're familiar, they do microchips. So these guys actually, create the microchips that go into things like iPhones. And you can see it's been beat up like everything. $128 down to $80. It's not even up today. It's actually flat. It pays a 2.1% dividend yield. I think I bought this probably around the same price, $75 or something last year. And I was all excited because it was up big. And here we are back to where we were. But, you can see here, there's a Argus upgrade Skyworks to buy from hold for $112 price target. Will it get back to $128 anytime soon? No. But is it worth more than $80? I think it is, but that's your decision to make. 16 PE ratio with a tremendous super cycle in front of it for 5G. To me, it seems like a great pick. You can decide for yourself. So obviously we already had Nvidia. They're a little bit different because Nvidia isn't focused on phones. And this is going to be much more semiconductor, including intellectual property, amplifiers, antenna tuners. So these antenna tuners are what you need when you're creating cell phones, and this is what they're most known for. But they do other things like LED drivers, low noise amplifiers, mixers, et cetera, et cetera, et cetera. So not only just phones, but also in aerospace, automotive, broadband, cellular infrastructure. Most people know them for the cellular infrastructure. Connected home as well. So when you think of, your connected home, I'm not sure if it's Alexa or Google or who uses them, but there's tons of different connected home devices now. So they do some of the work in that. industrial, medical, smartphone, tablet, wearable market. So I think the Apple Watch, Fitbit, things like that also. So I think it's a good company. I think it's one to take a look at. This one certainly could go lower, but Skyworks Solutions, I think, has a great 5G story, and it's one that you can take a look at. Okay, so number 6 is stock ticker SNX. It's Synnex Corp, and this thing has been absolutely annihilated. And the reason it's been annihilated is because it focuses more on the hardware side. And if you know anything about bear markets, if you know anything about recessions, one of the hardest hit industries is going to be anything that's hardware related in technology. The reason for that is when you think of software, we're talking earlier about, software as a service. We're talking about subscription type models like a Microsoft where you have recurring revenue. With something like a Cisco or a Synnex, the problem is that if I need to upgrade, say, my IT infrastructure, right? So I'm a business and I've got a little data center, basically a little IT center that has all my databases, and it's running on old technology, and I need to update that. Well, if times get harder, that's the last thing you're going to spend money on. You're just going to deal with a little bit slower process, a little bit slower server. You're not going to go out and spend a ton of money replacing hardware. It's the last thing you're going to do. You're only replacing that stuff when times are good and you have the capital to do it. So this one, of course, is going to have some risk, but we're talking about an 8 PE ratio, a 0.775 year PEG ratio, a 1.86% dividend yield. They've had really good dividend growth. It was just at $153 and now it's trading at $86. So if you think that, and they're going to announce their first fiscal 2020 results on March 24th. So you'll probably want to wait till earnings to see how they're doing and see, what kind of guidance they give perhaps. But who knows at that point, it could be way lower than this. It could be way higher. I'm telling you though, at $86 when it was $150, it's definitely one that, that I would consider on my radar. I don't own this one, but it is on my shopping list. I, want to dig in a little bit more on it, but I wanted to kind of bring it to you from a high level. Their website's not impressive whatsoever, but here's a quick shot of what they do. So they boast an extensive line of IT peripherals, IT systems and servers, system components, software, communications, security equipment, consumer electronics, software products. So they are a blend of software and hardware, but I think that when people think of them, they automatically are going to, look at the hardware side, and it's a big part of their business. So this is Synnex Corporation. Take a look. It's one that, like I said, has been beat up really, really bad. It was acting extremely bullish. Up to this point, you look at their earnings per share. They had a Q4 beat of 65 cents. It comes down to when the sentiment turns. These are the type of companies that are going to get hit first. Just like I said, or like I said earlier with a Cisco. Cisco's been crushed as well. Let's look at Cisco. Actually, this is unscripted here. I wasn't gonna pull up Cisco, but I'm actually curious. So Cisco went from, I think it's a $45 stock. It was $58 and now it's $34. It's paying a 4.3% dividend yield and a 13 PE ratio. I listened to actually the last 2 earnings calls. They had, weaker guidance. Same reasons I was mentioning earlier. The sales cycles they're already longer and they get slowed down exponentially when there's any kind of slowdown in the economy. It's the first kind of thing that gets cut off the budget. So I own a lot of this. It's one of my top 20 holdings. I thought it was going to be a good turnaround story for the end of this year. It still could be. They're paying you a 4.3% dividend yield to wait. It's got a healthy balance sheet. It's not going out of business. It's not, it's not in risk of not paying the dividend. I don't even think it's going to cut it. Could all that happen? Sure. But this is definitely one to look at. We'll call it a bonus pick. We were just talking about a different one with Synnex, and I wanted to take a look at Cisco as well. So number 7 is going to be ADP, which is automatic data processing. So they do, like if you're getting paid, they do your payroll, right? So they're cutting checks to you. They're doing your ACH. This thing has also been beat up like everything else. It was $182 and it's now trading at $134. The 52 week is actually a 15% negative. pays a pretty nice yield, 2.79%, and 23P ratio, and it's done well. I mean, it's an older company. It's a fairly mature company. They provide cloud-based human capital management solutions, cloud-based platforms, HR outsourcing. So they do other things other than payroll, but when you think of ADP, it's about payroll. So this one is definitely one that I have on my shopping list to add. If it goes down to 125 again, I'm probably going to grab quite a bit of ADP. The next one on the list is going to be Comcast, and that's CMCSA, and now it's paying a 2.63% dividend yield. It's a 12P ratio. Went from 47 to 34. It's beat on their earnings 3 consecutive quarters. Of course, the cable company, right? So they operate media and technology company, cable communications, cable networks, broadcast television, film and entertainment. Most of them think, Comcast. So the parent company of CNBC, which I have on in the background, they do things like cable, internet, Xfinity, NBC Universal, Sky, Comcast Business, etc. So, cutting the cord is a risk with Comcast, but they're diversified outside of just TV networks, and they also have Peacock streaming service coming out here soon. It's like Comcast is kind of NBC affiliate, whatever, but they, it's one that I don't own it. I think that it's one that I, probably would look at. But when you look at the numbers, I'll show you in the top 10, it's pretty solid. Number 8 is Comcast, and this actually has performed really well. Of course, you look at the chart, it doesn't look that way. And if you look at the 52-week, it doesn't look that way. But if you look at the last 10 years, they've done really well. It is an attractive yield at 2.63%. The PE ratio is reasonable. It's a 12. Most well known, I think, for NBC. They're the parent company for like CNBC that I have on in the background all the time. They've got different theme parks. High-speed internet, I think, is the main thing that most people know them for. And I think that there's just more and more demand. So you think of, they have gigabyte services, things like that. The company that I get my internet through is not Comcast, but it's Midco, and they actually own like 20% of Midco. And I think you're going to see more and more of that with people streaming with Roku, with Netflix, with Amazon Prime, with Apple TV, Disney Plus, all these different streaming devices. So there's definitely a demand, especially for high speed, and they are really a dominant player. They've got the most capacity in the high speed space, and they're very, well diversified, and I think they're going to do well, long term. Are they going to be a tremendous growth stock? No, but they've got an attractive dividend. And at this price, I think it's a pretty safe, nothing's safe, right? But I think it's an attractive investment with upside potential with a strong, yield. And I think it's one, if you hold it long term, you'll probably do okay. The thing that makes me nervous, like Viacom, and I know they're different companies, but Viacom has just been absolutely butchered. And so I always get a little bit nervous. I don't own Comcast. When you see the top 10 comparison, though, it's impossible not to include it because it's performed that well. And when I look at the prospects and the growth opportunity, it's there. So take a look at it for yourself. Peacock is going to be coming out here relatively soon, and they're going to have some different partnerships with Hulu and things like that. So they have NBC Universal, NBC Entertainment, Universal Film Entertainment. They've got all the Universal Parks and Resorts, which are closed now. That's something to keep an eye on because just like Disney, they're getting hit pretty hard in that segment. Sports, which is another area that's going to get hit. So it's not one I would probably jump in with both feet right now. If anything, maybe I would dollar cost average dip my toe. But you can see it was down to 34, so it's up. It was up 5% earlier today. Looks like the Dow is hanging in there, up 4.2%. S&P's at 2580, which is a lot better. The futures were down to under 2400 last night. So, but this one's been beat up pretty good. It's one to take a look at. There's some risk there with the current environment, but it definitely has some good reward potential and a nice yield while you wait. So take a look at Comcast. And then number 9, this one originally wasn't on the list. So I've been working on this list for 2 weeks, and it wasn't on the list And the reason I'm including it is I feel like I thought maybe it was a little bit too expensive 2 weeks ago when it was $48, but now it's $35 and it pays a 2.14% dividend yield. The PE is more reasonable at 20, but it also has, I think, some catalyst because more and more people were buying Logitech. So if you're not familiar with Logitech, you're talking about equipment for, video gaming, things like that, right? So you think of like the camera you're looking at, it's a Logitech camera. Microphone, they make microphones, different headsets and gear for Xbox, PlayStation. And then more importantly, I think, for this current situation, if you're using Zoom or you're doing more and more work from home and audio conversing, you might have never worked from home before. Now you need to go get a Logitech, you need to get some kind of camera, a webcam. Well, if you go on Amazon and you type up, webcam, Logitech is going to come up and they've got a wide variety of choices from 4K cameras down to just standard cameras and, different price points. But even the 4K cameras, like this is a 1080p camera, it was only like a $75 camera. So, they've got some good value there and they still make good profit on that $75 camera, but you're going to see more and more people that are now working from home that have to go buy a webcam. So I think for me, the fact that the price has dropped so much from 48 to 31, 35, and is now an attractive PE ratio, nicer yield, I think this one has a compelling story. And so I actually replaced Activision Blizzard. Now, Activision Blizzard, you could have easily included here at number 9 because of the fact that more people are going to be playing video games because more people are at home. So they kind of go hand in hand, but I do like this one because it's got a much better yield. I think it's a much more stable growth model. Activision Blizzard does have some issues right now with their Warcraft franchise, Diablo. Will Activision Blizzard be okay long term? Yes, but I picked Logitech over Activision Blizzard. You'll see Activision Blizzard as a bonus pick later. And I actually owned Activision Blizzard for a long time, like 10 years. When Activision bought Blizzard, whenever that was, I bought them. I actually had them before Activision, but I was a big Warcraft guy, so I thought it was cool to own that. But back then, nobody wanted to touch a video game stock, and it's kind of like that again nowadays, it seems. But for a while, they were the hot thing. Take-Two and EA, and there's a bunch of them out there. Made a lot of money on NetEase, if you're familiar with that. Chinese, they do a lot of mobile apps and things like that. But anyway, I digress. Number 9 is Logitech, and number 10. So I'm going to do number 10, and then we're going to do the review at the end. We're going to do a comparison, and then I'm going to give you some bonus picks after that. So Accenture is number 10, and I know Accenture well because I work in the cloud space, and they do a lot of services. Now, I've been wanting to buy this stock for a long time, and now I have a great opportunity. I should have probably bought it at 147 yesterday, but I didn't, and I waited. I probably will have another chance, but I think anything at $150 or less on Accenture, that's at a 20 PE ratio, 2.1% dividend yield. Zach says downgrades Accenture from hold to sell. I don't really trust Zach's ever though. And the price target to 200 from 230. Okay, so that's reiterated. Citigroup also reiterates a buy rating. So if this is a $200 stock, $150 isn't too bad of a price. What does Accenture do? Well, they do a lot of consulting, technology, outsourcing. What I know them best for is they'll go in and actually implement. They'll help clients that say are on-prem, help move to cloud. They'll implement, say, Oracle cloud applications. Any kind of IT infrastructure work, they have consultants that can do it. So Accenture is one of the best publicly traded companies if you're trying to capture that market. It can have, ups and downs and volatility. If you look at a 10-year chart, let's just see what the 10-year chart on Accenture looks like. You can see, wow. So, I mean, it's that chart looked really good up until now, but I'm telling you, like, you look at, this is the December 2018 lows. It got down to 133. Could it go that low? It could. I don't see it going any lower than 133. But you see what it did afterwards, and there's really not much that's going to slow it down. I mean, people are going to need consulting services when they do any kind of IT activity. So yes, if we have a recession, that's going to slow down. But at some point when, say, PeopleSoft is no longer serviced by Oracle, what happens? You're going to have to do something. So they're going to need companies like Accenture, and there's other ones. There's PwC, there's Deloitte, there's a bunch of them. But I like Accenture. They've always done a really good job, been very professional. They obviously do accounting services, and there's lots of other things Accenture does. But what I know them best for is going to be in the IT services space, and they do a great job of that. They've got a strong presence in that, and I just don't see them going anywhere for a long time. So I had to include this in the top 10. When I do these top 10 videos too, I could have easily put, 3 other semiconductor companies on here, but then you're going to have a top 10 with, half of them being semiconductors. I did my best to mix it up, so you have the, Apple, which obviously phones and software, you got Microsoft, going through the line. If you look at the top 10, there's similarities on some of them, but they're, at the end of the day, they're all very different companies. I think Accenture rounds out that list of 10 very well. You'll see in the bonus picks, there's lots of other companies that easily could have made this top 10. Stay tuned. What we're going to do next is we're going to jump into a comparison, and then from there we'll look at the bonus picks. So let's just go right to the stock screener page. Now, again, when I do a stock screener like this, guys, I'm not just doing a stock screener and saying, oh, this is, I'm going to buy this. In fact, these are the ones I selected after doing a bunch of research. But if I were to click a couple boxes, you would see 100 other stocks in here. So there's a ton of stocks that would have fit, especially in information technology. There are a ton of stocks that would fit into the DGIF model because it's really about growth and dividend growth. And there's just a ton of companies that would hit the metrics very easily. So you look at total return. So we're looking at a 10-year annualized return. Let's just go and look at who has the best 10-year annualized return. And all these numbers were a lot higher, of course, a week or two ago, even 3 days ago. Nvidia has performed about 30% a year annualized over 10 years. That's amazing. Dividend growth rate is still pretty darn good at 13%, and they're only doing a payout of 10%, which I like because you can invest more in research and development and grow the company. And that's why I like having that low dividend payout ratio, albeit the dividend yield, of course, is low too. Apple is number 2 with 24, Lam Research 22, Microsoft about 20, Skyworks 19, Activision 17. So the worst one's Logitech at 10. And 10% is actually underperforming. In fact, these 3 are all underperforming. Disney. So Disney actually didn't make the top 10. It's a bonus. So let's explain that. So Activision right here is a bonus pick, and Disney's a bonus pick. So we're going to cover 2 bonus picks while we're doing the top 10, and I'm going to have more bonus picks afterwards. Disney, it's been beat up pretty bad, just like everything, but this thing is trading right now at under $100. Their theme parks are all closed. People aren't going to movie theaters. People are afraid to buy the stock. It was $140. Now it's, it was trading as low as in like $85 or something yesterday. It only has an 8.8% dividend growth rate. It only has a 12% 10-year annualized return. The yield is 1.9, but I believe in the company long term with Disney Plus and with all the different things they have going with Marvel, with all the different things that they, Star Wars. I think Disney's one that you can feel pretty good at night knowing that you're probably not going to go to zero when you own a Disney. They've got a lot of tremendous assets. So that is a bonus pick. The reason it's a bonus pick is it hasn't performed as well as it should. And then Activision, you can see the performance is actually quite good on Activision. And I easily could have included that to Logitech. So you could pick between Logitech or Activision. I went with Logitech just given the current environment. I think that there's maybe a catalyst there, but you could argue that Activision has the same catalyst. The difference really came down to the 0.75% dividend yield versus 2.14% on the Logitech yield. And Logitech actually, I feel, is a little bit more undervalued at this point than Activision, just in my opinion. So let's go ahead and take Disney and Activision off of here. And we're going to hit go. See how fast this is. All right, we'll go show all. You can see when I hit show all, you can see, look at all these stocks. Oh, well, I'm glad I did that. So Visa and MasterCard and all the fintech, those are technically technology, but we included those in the financials. So if you're looking for why isn't fintech in here, I include fintech and financials. So you'd have to go back to the financial video. There's Visa and MasterCard are both on there, but go ahead and take a look at that. So show only selected. Let's get rid of those 2 bonus picks. So here's the top 10. We took out Disney and we took out Activision. And so you can see, the best performers Nvidia, the worst performers Logitech. This SNX, all these numbers would have been a lot higher, but they literally cut their price in half because of this recent crash. So could it be a good buying opportunity for that one? I think it is, and that's why I included it. And it does have that 1.86% dividend yield. And the dividend growth is actually pretty good too, is another reason I had to kind of include the SNX in there. Let's just look at the dividend growth while we're doing that. So let's look at industry and sub-industry. So LAM is semiconductors, but it's equipment. Skyworks is semiconductors. So these are both in semiconductors. One makes the equipment, one makes the actual semiconductors. Now, Nvidia is also a semiconductor, but completely different because the things that they're focused on that we talked about earlier are completely different. What Nvidia is focused on is very different than Skyworks. They compete in some areas, but they're very different companies. SNX is technology distributors. That's mostly electronics equipment and components. Logitech is more technology, hardware and peripherals. You're talking about webcams like you're watching me on, and microphones. Comcast, you got cable and satellite, so that's going to be communication services. You can see that we're covering IT and communication services, and there's only one stock that actually falls in communication services, and that's Comcast. Now, there's going to be a bunch more communication services that have very attractive yields, but they're going to be in the bonus picks, so stay tuned for that. We also have ADP, which is data processing and outsourced services, Microsoft, which is system software, Apple, which is technology and peripherals. They also have the services business, and then Accenture, which is IT consulting and services. If you ask me, that's really well-rounded for those 10 picks, and I try to do my best to make that happen. I also tried to give you a very attractive yield overall because, when the market's a little bit down, we might have a couple bad quarters, whatever. It's good to have that dividend yield and to get some kind of return on your investment while you wait. So the only one that doesn't have a great yield is going to be, of course, Nvidia at the 0.3%. Apple's a little lower at 1.24, but you can see you got Skyworks over 2, Lam is about 2, ADP is really solid at 2.79, Comcast is 2.63, and then Accenture is a little over 2%. Dividend payout ratio, I like to have 50% or less. Of course, there are exceptions to that, but in this case, ADP is just over 52, which I thought is fine, especially with a 2.79% dividend yield and a very healthy balance sheet overall. And then, these are just awesome dividend payout ratios, 10%, 15%, 30, 32. Accenture's only at 37% with a 2% yield. These are the kind of stocks I like. Give me a Microsoft that pays a 1.5% yield, that has a 33% payout ratio, that grows at least 10% and has a 20% annual return with catalysts for growth. Those are the companies that I want to own. And I don't care if they go down. If they go down, I want to buy more. If you're not compelled to own something when it goes down a little bit, don't buy it. That's what I like to say. I want to look at one last thing here, and that's going to be the dividend growth rate. So LAM, you can see LAM Research. I love this stock because they have actually increased their dividends by 44.9% on a 5-year average. That is a tremendous dividend growth right there. Skyworks, really good, 27%. SNX, another reason they got included. They've got really good dividend growth at 26%. Logitech's almost 23%. Comcast, pretty solid, 15% for a fairly mature company that doesn't have a huge payout ratio. I thought those numbers were pretty good. And you can see Comcast has actually outperformed the S&P over the last 10 years, and that's after a huge dip. They've averaged a 17% total return over the last decade, which I think is pretty solid. And then you get down to Nvidia. Well, they only pay a 0.3% dividend yield, but they have a 14%, 13.5% dividend growth rate, which is really solid. I like to have at least 10%. Accenture is just a little bit low on that. But you can see those are really solid picks, guys. Stay tuned for the bonus picks. You're going to like some of those as well. All right, guys, we're going to do the bonus picks in kind of different waves. So this is wave one of a couple different waves of bonus picks. And the first wave has ASML, which is going to be ASML Holdings. It's going to be a semiconductor and equipment company. It's very similar to Lam Research. There's about 3 or 4 of them that could easily be on here. That you can see the 22% 10-year annualized return. It's got a 28% dividend growth rate. It's got a pretty low payout, pretty solid yield. I don't like it nearly as much as Lam, but it's one you can take a look at. I think Lam is the best of that group for the semiconductor equipment. Applied Materials would be a second for me. The next one on the bonus is Nexstar Media, and they do communication services and media. It's a broadcasting company. Really, really solid. 3% dividend yield, 18% payout, 24% growth, 32% 10-year annualized return. Why didn't it make the list? It didn't make the list because when I dug into it, I don't really like it from here. So, they say we don't care where a stock's been, we only care where it's going. And that's true. But at the same time, performers often continue to perform as long as they have the growth drivers for it. Nexstar Media has done really well, but I feel like that's going to deaccelerate, and it's not something I feel good at night when it goes, when it goes down 20% and I have to go to bed. I don't feel great about owning Nexstar Media Group. But with that said, it actually has very good stats and it pays a really good yield. So I wanted to include it as a bonus for you to explore on your own. Next one's Oracle, which is one of my top 20 holdings. It hasn't performed very good over the last 10 years, as you can see. The reason I haven't sold it, there's a few reasons I haven't sold it. I've always thought it's undervalued. I still think it's a $60 stock. It's actually up today. It's up 14% today. And you can see that, wow. NXST is actually up 15% today. So maybe there's something with that. Oracle's up 14% today, up to 45. I think it's a $60 stock. It almost got there about a year ago. It's a misunderstood company. I worked for Oracle back in 2008. My shares are in the teens, so I'm up really big on these shares. And if I sell them, I got to pay taxes. And you say, well, that's stupid. The thing is, though, is I'm not worried about it long term. It pays a good yield. It's paying a 2.4% dividend yield if you bought it at today's price. Now, my cost basis on this is like maybe $15. And so if you do the math on that, if it's paying a 2.4% dividend yield on $45. If my cost basis is 15, right? I got a pretty good yield on that. And that's why if you look at my actual cost basis on it and my yield, it's really solid. So I collect the yield on it. I reinvest it, and currently it's into Oracle, but I probably, could start reinvesting that outside of Oracle, but at some point I will sell. I actually owned twice as much as I do now. I sold half of it last year and I repositioned it in Amazon, which was a really good move. But, Oracle has, held up fairly well, through this downturn, and they had a really rock solid quarter. They're starting to accelerate their cloud. Take a look at it for yourself. Most people don't like it. They try to compare it to IBM and things like that, and that's fine. But it has a solid dividend growth rate. It has a solid dividend. They can afford to pay the dividend. The company is not going anywhere. And it's one that I know that company better than any other company. And I know that if the price goes down, it's going to go back up. And that's why I haven't sold it. It's for me, it's a safety stock. It's about as safe as a Procter & Gamble to me because that's what I know. And it's also something that, I'm up so big on it that even when it drops 20%, I'm up really big, and I know it's going to go back to where it was. But it will be a $60 stock. It's just a matter of time. It should be there right now, in my opinion. Cisco is another one that's in my top 20 that's been annihilated, and I've been a fanboy of Cisco for a long time. These type of stocks don't do well in down environments. I talked about it earlier. So if you didn't watch earlier, basically the first thing that's going to go, the first budget that's going to get cut is going to be hardware IT, and that's Cisco's main focus. There's still a tremendous opportunity there with 5G. The problem is when you think of the stock price, Wall Street only cares about now. They don't care about 2 years from now necessarily. So it's not giving them enough return in a short term. You think of a hedge fund manager that has 1 year to get X amount of results. Cisco might not start performing for a couple more years, but I don't mind owning it and waiting and collecting my 4% yield. Mine's not quite as high because I bought it higher than where it's at today. But Cisco, at $34, the PE on it, let's just look at the PE. The PE on Cisco right now, if you were to buy a share at $34, is 12.97. It's down 36% on the 52-week. So, do your own homework, decide what's best for you. If you're young, it's probably not the first pick that I would buy with everything else down, but I do like it as a DGI stock with a solid yield. AT&T is the fifth bonus on this round, and it pays a great yield. I like to call it my bond. This kind of sits there and collects yield. It's got a high payout ratio. It's got issues with DirecTV. Their customer service isn't great. I'm a DirecTV customer. I'm a AT&T customer on my phone. Their customer service is terrible. There's a lot of things not to like about it, but at the same time, they own HBO. That dividend is pretty safe. I wouldn't say it's 100% safe, but it's pretty safe. They definitely can pay the 6% dividend yield, and I think there's upside to it with 5G. I think AT&T will benefit from the 5G cycle, and I think that Time Warner Cable, that acquisition, they still haven't untapped the potential opportunity with Time Warner. And I was a Time Warner and AT&T holder. I had both, and basically what happened with the merger is they sold all my. They gave me money, and then I think half of it was cash, half of it was AT&T shares. So I got more shares, and then I took the money and actually bought more AT&T. So it's one of my top holdings, and it helps my yield significantly because AbbVie and AT&T, both have really good dividend yield. So that's the first round. Stay tuned for the next round of bonus picks. All right, so the last round of bonus picks, there's only 2 rounds. There's 5 before, there's 4 here. So there's only 9 bonus picks. I have a lot more. And what I've decided to do is I'm going to do a top, and I don't know if I'm not sure on the number, but I'm going to do a top semiconductor DGI video. In fact, it might even be just a top semiconductor stock video because I want to have AMD in there and they don't pay a dividend. But there are so many good semiconductor stocks, and I'm going to cover one more in here with Applied Materials. But just on my sheet here, I've got 1, 2, 3, 4, 5, 6, 7. I've got over 15 semiconductor stocks that you can look at, and almost all of them are really solid dividend payers. So, we covered Nvidia, which isn't a solid dividend. But we covered Nvidia, we covered Lam, we covered Skyworks. There's so many other ones. And I own a bunch of these, and I also own SOX, SOXX. That's the SOX, Philadelphia Semiconductor Index ETF, semiconductor ETF. So that's actually a really good way to play it. But I do want to cover all these semiconductor stocks, I think, in a video and go into more detail because I do have a lot of good information on some of these, like Texas Instruments, where they do a lot of work in the autonomous driving space and things like that. So Verizon is the first bonus pick. Obviously, it doesn't necessarily fit the parameters. It's performed better than AT&T. If you remember, AT&T was something like 7%. This one's 11.7. So it's performed pretty well, and it's got the 5G super cycle. It's held up pretty darn well in this downturn. I mean, it's still down, but it's not down as nearly as much as some other things because it pays a 4.8% dividend yield. Everybody knows they can afford to pay the yield, and everybody knows that 5G is coming. and they don't have the problems that AT&T do. So, this is at 4.8%. I'd probably buy Verizon before I'd buy AT&T, and I do own both, but I do own a lot more AT&T. My yield at AT&T is probably close to 7% or something like that because I've had it for a little while. My cost on yield. Second bonus pick is Cognex Corp, and they do another one that does electronics equipment that got hit really hard, but it has performed well. 24% total annual return. It fits all the metrics. It has a little bit lower yield, and I just think if I were gonna pick one, I'd probably pick SNX, maybe even Cisco before I'd pick CGNX. But it is one you can take a look at. IBM, I own some of that. It's performed pretty bad. 10-year average return is 0.79%, and that's pretty bad. I mean, the 6.3% dividend yield. The growth on the dividend's only 8%, so it doesn't really meet any of the criteria. I do think it has a lot of upside potential with the new CEO, with Red Hat, with cloud, but it's a high risk type opportunity. It pays a 6% yield though, so if you want some yield, you're not going to get it from Treasury bonds. So if you want some yield, IBM is kind of like an AT&T. It's basically a bond that has some problems, but probably will keep paying the yield, and it might not perform, great as a stock, but it could. I think IBM probably has more upside than AT&T long term, but I think AT&T maybe has more upside in the short to midterm with 5G. IBM could take a long time before that story unfolds, but I do like Red Hat, and I do like the direction that they're attempting to go. Applied Materials, another one. It's in the semiconductor equipment. You can see a 16% annualized return over 10 years, 16% dividend growth, 21% payout ratio, and a 1.86%. So stay tuned. I'm going to make a top maybe 10, maybe even 15 semiconductor video, and that way you can pick. If there's one or two in there that you really like, you can go ahead and pick the one you like best and buy it. If you can't decide, then you can always buy the SOX semiconductor ETF. But that pretty much does it for today's video. The series has been excellent. If you could just give me one more minute of your attention before you take off. It's been really fun making this series. I can't thank my fans enough, the ones that that have watched every video from start to finish. There's quite a few out there that actually do watch the entire video. I don't know if you know this, but I can't see who the people are. I have a good idea who they are. But you can see the number of people, the percentage that watch 5 minutes, 10 minutes. And surprisingly, there's quite a few people that watch the entire video, even when it's an hour long. So I can't thank you enough for that. I try to do my best to bring, information to you to help you with your investment decisions. Obviously, the time that we're in right now is difficult, but in my experience doing this for a while, since 1999, these are almost always buying opportunities. And eventually, if you've got stocks that are red right now, I've got a lot of stocks that are red. They'll bounce back, and it might not happen overnight, but don't go panic sell right here. Are we at the bottom? Maybe not. Could we go lower? Sure. But, President Trump's on right now declaring emergency plans. And I feel like, we're heading in the right direction. And I think that, America's economy is strong. I think that we'll get through this like we have so many other things. You look back in history, we've overcome adversity every time. So we'll do it again. Might not happen in a week. It might not happen in a month. Hopefully it does happen that soon, but we will overcome, and the world's not coming to an end. I think the economy is still going to be strong when we come out of this mess. And I think that if you're buying and dollar cost averaging some of these high quality dividend growth companies, and even some of the growth companies that you're going to do fine, the stuff that's highly leveraged with, 200 PE ratio, those might not bounce back as fast, but that's why I like these dividend paying stocks, because at least you're getting some money. Heck, you can buy a Lam Research and get a 1.93% dividend yield. A 10-year treasury is, earlier this week it was paying 0.4%. I think it's just under 1%, but you can double your money on Lamb Research and have potential to gain, even if it only gains 10% a year, you're gaining, 10% versus 1%, if this is a total annual return. So, hang in there, do your best to stay positive. I know it can be difficult, try to, especially individual stocks. If you find some of the deals right now are literally giveaway deals, that you'll probably won't see in a lifetime. I believe that no matter, who you talk to, if you go online, it's, we're going to 15K in the Dow. Well, maybe we are, but what are the chances that we go to 15K in the Dow? Maybe we do. And that'll blow up my face. But I've been buying since, 5%. And as we go lower, I buy more and more and more. And I'm, getting low on cash. So hopefully we hit the bottom and I'm like, hey, that worked out great. If we go up 5% from here, I'm green on everything I bought because of the way I've bought it. So there's different strategies out there. But if you like a stock and you're a long-term investor, don't let, somebody tell you like, don't buy Disney at $85 because it's going to go to $45. I had somebody tell me that today on Facebook. And if you really believe that Disney's going to $45, then you go ahead and wait for $45. Let me know because, I'll be buying a bunch of it at $45 as well. But, you got to be realistic too. It's good deals, but you're not going to get a company that like Disney that was $140. The likelihood of going at $45 is pretty low. So you can chart, maybe that thing gets to $70 or something. That could be feasible, but you have to be realistic. If you think everything's going to go to zero before you buy, it's going to go up. And, is this the bottom? Probably not. We retest the 2350, probably, right? Can we go lower than that? Sure. But if you're waiting for us to hit 15K Dow, if we never hit 15K Dow and we all of a sudden rebound in a month, you're going to wish that you were buying some of this stuff. That's all I'm saying. So I'll stop preaching. I know most of the people that have watched this long, I'm preaching to the choir anyway, if you're listening to this point, but thanks for your time and attention. I probably won't be doing another video series of this length for any time soon. If you have any ideas for videos, let me know. I think the next thing I'm going to do is that semiconductor one. And then I'm going to do a lot more of the 5 and 10, 15-minute variety, just because those seem to be more popular with the masses. But I'm open ears, so drop comments below if you've got ideas of different video series I can make. If I should do personal finance series, whatever, anything in the realm of personal finance or stock market investing, I'm open to doing a video. And if I don't know the topic, and I'm not going to do a video on it, I'll let you know. But if you haven't subscribed, please do. Bottom right-hand corner, click on that. Click the like button. That does help me kind of get into the algorithm. And drop a comment. Stop by our Facebook page, our Facebook group. Go into Facebook, type in Fired Up Wealth. I'd love to see you on there. We've got about 1,400 members. We like to have conversations on there. But thanks for your time and attention. Appreciate it. I've had fun making this video series. I hope it helped you. Have a great rest of your day. Take care.